Joining us now, Ray Attrill. He is head of currency strategy at BNP Paribas. He's also one of the original founders of Forecast in London, and Ray joins us from his office here in New York. So, Ray, let me ask you, are you a dollar buyer or a dollar seller?
Well, I think I'm back something of a dollar seller. It all depends on risk appetite. So that big contraction in the IMM net short position that you talked about is very much the flip side of this extreme bout of risk aversion that we saw last week. And I think the way to characterize that is in terms of risk capital is flying home from all corners of the globe. But a lot of the money that's in the US tends to be hedged. So when that money flies out of the US back to Europe and to Asia, there tends to be very little currency impact. But if US investors take fright and bring money out of emerging markets or out of Europe, bring that money back home and put it into treasury bonds, for example, then that really means the sale of foreign currencies and the buying of dollars. And that's why the dollar rose as much as it did last week. But with now 3 or 4 days away from those calamitous times in equities, and with signs that risk is coming back on the table, then we're seeing the dollar starting to seep lower again. And my guess is that that trend is going to continue from here.
And just how low could the dollar go, Ray?
Well, a lot depends on whether the Fed is really going to pull the trigger on another round of quantitative easing. We had a pretty strong signal from the Fed last week. In our opinion, that last paragraph really opened the door and suggested to us that Ben Bernanke is going to drive the QE train a little further down the road, even over the heads of some of the dissident members of the FOMC. And if he does follow through on that, while other central banks still seem somewhat reluctant to follow what the Fed is doing, then I think that's a recipe for further dollar weakness. So we could easily see another 5% or so off the dollar in the months ahead.
You know, Ray, as I talk to traders down the floor of the New York Stock Exchange, money managers up here in the office, everyone seems to say that Bernanke has effectively told the world he's going to do whatever he's got to do in order to keep the market from melting down. Do you buy that argument?
Yes, I do. I mean, there's obviously a raging debate about whether QE2 had any real impact, but certainly there's a very strong correlation between the Fed's 2 bursts of quantitative easing and support that it's provided for risk assets, equities in particular. And so I think that Bernanke's view would be that another round here offers some chance of puffing fresh life into equity markets. And I think it's also important to remember that one of the transmission mechanisms, if you like, from Fed policy through to the real economy is via the currency. So if the currency is to weaken because the Fed's taking aggressive actions where other central banks around the world aren't, and we get a weaker dollar, then I think at the moment that's something that the Fed would welcome rather than be concerned about.
Now, is it possible to have a euro fall at the same time that the dollar falls? In other words, there'd be so much money going into these emerging market currencies like the Aussie dollar, for example, or, well, Hong Kong isn't exactly an emerging market, but you understand we're talking Asian currencies. Is it possible to have both the euro and the dollar down together, or is that simply not possible?
Well, we saw some evidence of that, where the euro was really sort of struggling at the same time that there was clearly a distaste for the dollar. And that's one of the reasons that the likes of the Swiss franc and the yen have strengthened as much as they have in recent months. So obviously, you know, sentiment towards the Eurozone is going to remain fickle as we wait to see how the EU agreement that was agreed last month plays out, and assuming that the substance of the principle comes together, we think that will support the euro, but there will be periodic setbacks. But in terms of money coming out of the dollar and looking for risk havens elsewhere or risk markets elsewhere, we still think the likes of Asia and Australia, New Zealand, to some extent Canada and Sweden and Norway may be the better beneficiaries of those flows rather than the Eurozone for the short term at least.
All right, Ray Attrill, head of currency strategy at BNP Paribas. Thank you, sir. It's complex stuff. We appreciate your help.